C3.AI, a very trendy company in the past few months, thanks to artificial intelligence, is down roughly 26% today as I am recording the episode. And if we take a closer look, the main reason is there was a short seller that accuses C3.AI of accounting irregularities. Let's take a closer look in today's episode. Like we can see though, C3.AI has done amazing year to date. It's up roughly 126%, and that's even counting with a 26% drop today with a market cap of $2.8 billion. That market cap we're actually going to take a closer look at in the short seller report, but it is a company that has kind of really been driven by this kind of AI hype, and obviously being a smaller company has definitely seen some great returns in the short term of things. So let me know, before we get started, let me know on the comments below, what are your thoughts on the short report if you have read it. If you have not, let's take a look right now. So we see this tweet from Kerrisdale Capital, and they said that they sent a letter to C3.AI's auditor, which is Deloitte, the audit committee, and SEC documenting serious accounting issues. They also mentioned that in the letter they addressed the following: how this company has grown their unbilled receivables dramatically in levels that they've never seen a software company do before, the confusing and highly concerning disclosures, also efforts to inflate gross margins, classification of significant revenue as subscription opposed to fees, and then the significant turnover in CFO. Before we go any further, I want to thank you for watching, and I need your help to reach my goal of 30,000 subscribers by the end of the year. So if you can do me a favor, hit that subscribe button and thumbs up. Also, if you want some fantastic insight into the semiconductor industry, join my other channel, Semiconductor Investing and More, where I use my electrical engineering background to break down the semiconductor market. Finally, I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode. So we can see here the letter starts off with pretty much like they mentioned they were going to send this letter to the audit team at Deloitte, and they're telling them, hey, before you guys start working on the next financial statement for the fiscal year ending on April 30th of 2023, we want to bring to your attention certain things that Kerrisdale Capital believes are things to keep an eye out. So they mentioned that in their opinion, C3.AI has utilized highly aggressive accounting to inflate its income statement metrics in order to meet sell-side analyst estimates for revenue and certain profit metrics, and to conceal significant deterioration in its underlying operations. The first thing they kind of want to showcase is this ballooning in receivables, in everything from accounts receivables to unbilled receivables to even a specific customer, Baker Hughes, unbilled receivables. So they do mention that days sales outstanding has ballooned to 197 days, a level unheard of among software companies, which C3.AI claims to be. And one thing we can see is kind of looking back to just a year ago, that number was roughly 100, and in just a matter of a year has kind of doubled. So that's the first thing that this kind of short report is saying. I do want to mention, and I forgot to mention this earlier, Kerrisdale is short shares of C3.AI. And that's to no surprise, right? Usually when we kind of hear about these reports, it's usually because there is a short seller behind it. So always understand that there is some form of bias in their end when looking at the negative of a company. Now, throughout the whole first 2 or 3 pages, Kerrisdale does kind of go about explaining the day sales outstanding and unbilled receivables and how they have ballooned. But what I want to take a closer look at is this accusation that the company is inflated their gross margins. And the company mentions that C3.AI reports research and development expenses that in both the most recent quarter and the last 12 months exceed the entirety of gross profit. And they are kind of saying that the company is reclassifying costs from cost of revenue to research and development expenses. And this is overall making it seem like this company has higher gross margins. So honestly, this is something that could be true, right? This is going to be very hard. I'm going to have to see how Deloitte kind of responds in the upcoming earnings. But that is something to keep in mind of, right? This is a company that's really focused in the new technology, right? Artificial intelligence. to some extent. So I want to say, because it's new technology, it might kind of create little opportunities, if that might be the correct word, opportunities for management to be like, hey, you know what, because this is emerging technology, maybe this cost that in normal businesses might be classified as cost of revenue, we can actually classify it as research and development expenses. And through this, we will be able to increase our gross margins, profit, right? And our gross profit margins. And like they mentioned earlier, right, in the most recent quarter and the last 12 months, gross profit, research and development expenses have completely exceeded the entirety of its gross profit. The other thing that I wanted to take a closer look at is this is a company that continues to do very heavy stock based compensation. And sometimes we have to remember that when looking at that market cap. Earlier, I think I said this had a market cap of roughly 2.3, maybe $2.4 billion. But this Kerrisdale does mention by their calculations, diluted share count is currently a staggering 38% higher than the company's basic share count. So obviously they're saying that, hey, this is a company that, one, is giving is giving great share compensations to their management. They're inflating gross profit, and in the long term, insiders are going to be the one that's going to profit and not the investors themselves. They do mention that this is a company that's supposed to be a software-based product. But based on their business diligence, the company, C3.AI, doesn't provide the sort of scalable software as a service offering that typically comes with high incremental gross margins. And again, they just continue to spout the idea that this company is hiding too many costs within research and development expenses that should be classified as cost of revenue. Outside of this, Kerrisdale also mentions that C3.AI is classifying too much revenue as subscription instead of maybe a fee. And they did kind of show some reports. They mentioned that, in fact, in its financial statements notes, C3 discloses that its subscription revenue includes stand ready COE, support services, and maintenance and support services. And they don't believe that this is necessarily a subscription revenue. They believe this is more of just a service fee. So they're saying, hey, there's no way that this should be classified as subscription revenue because it's creating some form of lie or some form of cloak, because normally when investors see subscription revenue, it tends to relate with a high margin form of revenue source. And the company also gives some examples of how software revenue or subscription revenue should be classified versus services fee. And they give an example of how Microsoft Word or Microsoft Word or Adobe Acrobat, when you buy their software, right? You're buying their software as a subscription service. You're not paying for a highly engineering team to build some form of customizable applications for the business case, and then kind of provide extensive ongoing maintenance to support and ensure that the application continues to work. So they're saying that doesn't sound like a subscription service, that sounds more like a fee service. I want to say I'm not a shareholder of C3.AI. I'm also not a short seller, but these 2 points are, in my opinion, are making sense. I do believe it is possible that the company could be hiding a lot of their expenses as research and development. And the second thing is, if this is exactly how they're kind of classifying their subscription revenue, then they should change that, right? They should have a subscription revenue source, and they should also have a service and fee revenue source, and not kind of lump it up together. The final thing the company does mention is that in the past 4 years, the company has cycled, C3.AI has cycled through 4 different chief financial officers. And another thing that they are mentioning is each chief financial officer has seemed to be a little bit less prepared. One, they're getting a lot younger, so in theory, that means they have less experience. For example, Mark Levine, he was previously the CFO of a large software provider, which has recently been acquired for $17 billion. And now fast forward to the current CFO. The current CFO had no prior chief financial officer experience before becoming C3's latest CFO. So first, I want to say I don't know if the experience level is something to keep an eye on, right? I mean, I do believe there could be great individuals that don't really have that kind of experience on paper, especially for a financial role as this. What I do think is interesting, though, is that there have been four CFOs in 4 years. Now, that to me is a yellow flag. Maybe not the age or maybe not the experience too much, as obviously this is kind of a AI company with emerging technologies that maybe you might want a new set of eyes, or someone who hasn't been tainted too much by the overall normality of the financial world. So that's pretty much the short report. I do want to say the stock price is down a nice amount, but remember, this is a stock that was up nearly 200%, I believe, year to date yesterday. So this is a company that's going to be very, very volatile due to the overall market. But again, I'm not a short seller. I don't tend to short stocks. I don't have a position in C3.AI. This is probably not a company I personally would own, but it does seem like the letter does come with some things for investors to keep an eye on, right? I'm not going to say the letter is true, but it does share some great information, in my opinion. And as an investor, it kind of gives you a side to think, it gives you the opportunity to think on the other side of the spectrum, right? If you might be a bull, it might give you the opportunity to think of the bearish case and really see your investment thesis. So I hope you guys enjoyed today's episode. Take care, have a good day, and see you next time.